In this video, I'm going to introduce you to the concept of accounting equation. This equation is the basis of the double entry system. Based upon this equation, the whole scientific method of recording, classifying, and summarizing the business transactions is done. So let's look at the contents of this discussion. I'll talk about what is the equation, I'll tell you how it works, and we'll do an example, and then I'll summarize, the importance of this equation. Now, all you need to know before you go through the accounting equation are the four concepts, four key terminologies of accounting, which are assets, liabilities, incomes, and expenses. So make sure that you are well versed or you have a good grasp of what are assets, liabilities, incomes, and expenses, and then go through accounting equation. All right. So as I said, this is a fundamental equation. Based upon this, the whole process, all the books of accounts are going to be prepared based upon this equation. And this equation represents the relationship between the four terms: assets, liabilities, incomes, and expenses. And the equation, what is the equation? The equation is that assets are equal to liabilities. And this is nothing new. In the previous video, I showed you that assets and liabilities are equal. Using the sources of funds under liabilities, you purchase the long-term assets that you have. So the equation holds. So all we are going to do in this video is establish your faith in this equation, help you understand more how this equation is going to hold. All right. So in this equation, you see that assets and liabilities are in the foreground. This is what you see. However, the other two terms, which are incomes and expenses, they are going to be functioning in the back end. For example, you saw in the previous video where we said using liabilities, you are going to fund your assets, and then using assets, you're going to generate the income, out of which you will pay your expenses, which will result in profit. And this profit is going to be channeled back into the company, and more assets can be bought and so on. So in this expression, this is the accounting equation. This is the accounting equation, and the other equation that you have for profit, this is basically channeling, bringing inputs into the liability side of the accounting equation. So that is what I meant when I said accounting equation is on the foreground of the whole thing, and this is the background of the accounting equation. Okay, let's move forward and look at the working of accounting equation. So the equation is assets equals liabilities, and all we have to do is we have to prove that this equation holds no matter what transaction takes place in the business. That's the meaning of really the equation, right? It should stay equal. So if you take, for example, loan raised, if the company raises a loan, meaning goes to bank, takes a loan, what happens? When a loan is raised, we know loan is a liability. We discussed that earlier. So on the liability side, there is going to be name of a liability, which is loan. You have taken a loan, and if the amount is given to you, let's say 100, so there is a new liability which is equal to 100. Suddenly the equation is not equal because there is something on the liability side, nothing on the asset side, right? But what happens when you take the loan? You have to return the money to the bank, but before that, bank deposits the money in the company's bank account, right? So the company's bank account becomes company's bank balance, and bank balance, as we all know, is an asset. So on the asset side, you are going to have an asset called bank balance. Bank balance is going to be 100 as well. Therefore, the accounting equation holds. After the transaction of raising the loan, there is a new liability which is getting created, and there is an asset which is getting created. So, again, re-emphasizing on the point that using the liabilities, which are sources of funds, you fund your assets. So we raised a loan, and now we have money in the bank account. Let's look at another example. What happens when you purchase the land? Now you have gotten the money in the bank account. Let's be using that same money to purchase land. So when land is purchased, the company owns new land. Land has a value. So there will be a new asset which is going to be called land. So if 50 is going to be spent on land, then the value of the land is 50. So the value of the asset is 50, and suddenly the equation is unequal. You have 50 on the one side and nothing on the other side. However, when you purchase the land, the title of the ownership of the land is going to be transferred to the company only when you transfer the money. That means you will spend the balance in the bank account. So the bank balance is going to be reduced by the same amount, and there you go, the equation holds. There is nothing on the liability side, but that's okay. You purchased land and you paid for it. You paid from the bank balance. Bank balance was also an asset. Land is also an asset. You are converting one asset into another asset. So that's how accounting equation again is going to hold even after purchase of land. Another example, income from sale. You sell goods and you make money. So what happens when you sell goods? The money is going to come in your bank account, or you get cash. Let's assume cash. So if the company is going to get cash, then let's say 20 plus more cash. So the balance in the cash in hand, that goes up, you have 20 more. Now what is the other impact of this transaction? We know that from income from sale, there are two things which are getting affected. You're getting an income and you're getting cash. The name of the income is sales, right? So the sale is an income, and we know that the accounting equation only has assets and liability in the foreground. In the background, they have income and expenses. And then you're going to have profit, and profit is going to feed into the liabilities as discussed earlier. Income minus expenses. So from this transaction, you have a new income of 20. So this cash is getting reflected here. However, this income is going to reflect in the other equation, which is the profit equation. So you have income, and right now in this transaction, we don't have any expenses. So I'm going to write it as 0 and 20 profit, which means that this profit is going to get added into the liabilities, and the profit belongs to the shareholders, people who have brought the money in the business. So the shareholders funds is how we call the total amount. The capital brought in a new profit. Shareholder fund is going to go up by 20. So that's how accounting equation still holds after an income entry. Let's look at another item. This is salaries. You are paying salaries. Let's say salaries paid 10. What happens to accounting equation? Now salaries paid are expenses. Expenses are not accounted for in the accounting equation. However, there is a background profit equation, income minus expenses equal to profit. This is where all the expenses are factored. So according to this equation, according to this transaction, no income is being made right now, but expenses are being paid. So you have a negative profit, a loss. And this profit is going to feed into liabilities. which means there will be a minus 10 in the shareholder fund. At the same time, the expenses are going to be paid out of the cash balance or the bank balance of the company. So I'm going to write cash here, and out of the cash you pay this 10. The accounting equation holds again after this transaction. So we saw a bunch of items, and we saw how the accounting equation is not getting affected. It's always equal. Assets and liabilities are affected in the same way. I have a bunch of transactions again, 8 transactions, and with some more details, some more complexity. Let's go through these and prepare the accounting equation. So shareholders invest 100 million in the business. Okay, what happens? Shareholders are bringing money into the business. Clearly, money is coming in, so you have bank balance which is going up. So on the asset side, I'm going to write bank balance. This goes up by 100 plus 100. At the same time, when shareholders bring in money, there is a new liability which is called shareholders funds, shareholders capital. So I'm going to say plus 100 in this case. So accounting equation holds. The next transaction is borrowed from bank 50 million for business. This is a loan that you take from the bank. When you take a loan from the bank, again bank balance goes up by 50, and there is a new liability called loan from bank, and this is also 50. There you go. Accounting equation again has 150 on one side, 150 on the other side. Then you have purchased office building. Now you're using this money to purchase some assets. You purchase office building worth 10 million and a storage facility worth 20 million. Two types of assets are being purchased. Now office building, I'm going to write it here. So I'll just put it in short, building, and the other one is storage. Okay. So I'm purchasing office building worth 10. So building, the value of asset that goes up, and a storage worth 20. However, I'm going to pay for these two facilities as well. So 30 million has to be paid. How do I pay it? I pay it out of my bank account. There you go. And no impact on the liabilities side for this transaction. Then you have purchase of stock of goods worth 40 million, and 50% of this is on credit. On credit meaning you don't pay for it, you'll pay for it later. When you are purchasing stock, a new kind of asset is getting created, which is unsold stock. Unsold stock is your asset. So I'll write it here, stock, and 40 million worth of stock has been created in the accounting equation. Now you have to pay for it, but you paid in cash only half of it. So half of it is 20. I paid through my bank balance because all the money is in the bank, and remaining 20 is what I'm going to pay. So whenever you have an overdue amount which you will pay, it becomes a liability. So there is a new liability, and I'm going to call it creditor, the formal word in the language of accounting for our vendors to whom we have to pay. The word is creditors. So creditors worth 20 million are created on the liability side. Now what happens? You have minus 20 and plus 40 on the asset side, which is a net effect of plus 20, and an equal plus 20 on the liability side. So accounting equation again holds. Transaction 5 is sold goods worth 20 million, and you have 50% on credit. Now you sold goods. When you sell the goods, the stock goes down. So the stock is going to go down by 20, and you sold goods worth 20 and 50% on credit. Now you receive 50% of the amount in cash. So bank account goes, I keep saying cash, but let's assume everything is through the bank account. So plus 10 million, however, remaining 50%, which is another 10 million, does not come to you. You have to recover this amount from your customers. So you have recoverables. Okay, so I have less space here. I'm gonna just write it here. Receivables. Receivables, we could also call it debtors. Debtors. That's opposite of creditors. You have to recover money from the customers. So what you have to recover from customers is plus 10, because 10 you have already received and 10 has to be recovered against a value of 20 million of stock which was sold to your customer. Done. Next is office expenses paid 5 million. Now this is an expense item, not an asset item, not a liability item. This is an expense item. When you pay an expense, you pay out of bank account. So minus 5. And we know any expense reduces the profit and hence reduces the shareholders' funds. So I'm going to do a minus 5 on shareholders' funds. There you go. Transaction 7, you pay salaries. Well, you pay office expenses or you pay salaries. It's an expense. Again, I'm going to pay it out of the bank account first of all, and then I'm going to reduce it out of the shareholders' funds, because any expense is going to reduce the profit, which reduces shareholders' funds. And then you have transaction 8, where you pay the bank loan installment of 10 million. When you pay the bank loan installment, the loan amount certainly goes down by 10. And on the other hand, you pay this out of the bank balance that you have. Again, equal amount being deducted on both the sides of accounting equation. So this is how accounting equation works. No matter what the transaction is, it is going to affect one or the both sides of the equation in such a way that equation is always going to hold. And at the end of these 8 transactions, what you have is 1, 2, 3, 4, and 5 different assets and 3 types of liabilities. What is the total, what is the final money left in the bank account? Well, you just can sum this up and figure out the balance in the bank. What is the value of the building? 10. What is the value of the storage unit? 20. The value of the stock, you are left with 20 million worth stock. What is the amount recoverable from the customers? That is 10. What is the shareholder fund? That is 100 minus 10, that's 90. A loan was taken 50, paid 10, you're left with 40 to be paid. Creditors worth 20. So at the end of the transactions, you are able to see the balances in various assets and liabilities, the value of assets and the liabilities to be paid. Okay, let's quickly move on to the summary of this exercise. The idea is that, asset, liability, income, expense, these 4 items are going to be involved in every transaction. And if we understand the rule for these 4 types of 4 terms, the rule using which you write it in the accounting equation, then it will become easier for us. So let me conclude by saying, if any asset is purchased on cash, then the asset goes up and cash goes down. However, if the asset is purchased on credit, you will have asset going up, and instead of cash going down, you will have a liability, a payable amount on the liability side. That is true for any type of asset. For any liabilities that you raise, if you get cash for it, then you have cash should be going up. Apologies for this. Cash should be going up and the liability is going up. And if you raise any resources instead of cash, you get an asset and you have payable against it. That's also possible. Another way of raising a liability. Then you have expenses. If you pay expenses in cash, then cash goes down and the shareholder funds go down. If you do not pay it in cash, then the shareholder funds go down and there's a new liability that you have to pay. So, and finally, for the incomes, if you receive the income in cash, cash goes up, shareholders funds go up. And if you do not receive it in cash, then the receivables, another asset, goes up and shareholders funds go up. So that's how any transaction is going to fall into one of the four categories: income, expense, asset, liability. And depending upon what it is and whether it is cash or credit transaction, it can be recorded in the accounting equation to see what is the final impact on the accounting equation. All right, I'll see you in the next video.